Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
You're watching Stockwatch. I'm Ntaoleng Lechela, and joining me to unpack your stock-related questions today are Grant Nader from Benguela Global Fund Managers and Pierre Verster from Protea Capital Management. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Gents, thanks so much for your time this evening. JP, let's start with you. The AI sell-off, right, showing no signs of slowing down. It's been, about 2 weeks. Are you concerned? Should we be concerned? Seems like fundamentals haven't shifted.
Yeah, evening, Ntaoleng. Look, when things get expensive, it's almost inevitable that you will see prices falling back. And the whole AI sector has been expensive for a while, so people have been waiting for a bit of a pullback. And now it's here. The question is this just going to be a pullback and then the bull market in the AI sector continues? Or is this the start of the piercing of the bubble?
Yeah.
Now, it's impossible to know which one of the two it is. I would just say that it's still a very expensive part of the market. There's a lot of excitement. There's starting to be some circular transactions where people are financing their customers, which is not healthy. So I'm cautious. I'm not yet saying that just because shares have fallen now for a few days that one should start buying. I would rather wait a bit to see how far this can go.
Which camp are you in, Grant? Are you buying the dip at the moment? I mean, we just heard of M&A activity between Nvidia, Microsoft, as well as Anthropic. Nvidia also out with numbers tomorrow.
So I'm not buying the dip yet.
Okay.
And what I will say is, given I think the markets have rallied at some point about 40% off the lows in April, and still up well for the year. In every strong market, you're going to have a correction. I mean, we've just actually had an amazing move without a correction. That's been the abnormality. So my starting assumption is that this is a correction within a bull market. But you don't also want to be too quick to pull the trigger.
Yeah.
Have your valuations, have your targets that you like, stocks you like, and this could be a chance to get them if they get to your price. Don't be too quick to buy the dip. Let it play out a little bit. But also, people often fall prey to everyone wants a pullback so they can buy, and then when it pulls back, it's like, oh my God, this is the start of no, I can't buy because it's going to go lower. So just have your plan and stick to it. So when they get to numbers that you like, the levels. If you want to buy Nvidia at 160 or whatever it is, if it gets there, you buy it. Don't try and get. It's hard to know short term, so stick to the fundamentals.
Yeah, investing is not for the faint-hearted, particularly if you're trading these stock and holding them on the short term. Let's get into some questions now, JP. A viewer asking what's behind the dip in Pick n Pay, and wouldn't the sale of those shares by the Ackerman family be viewed as a positive, considering that the market or investors have sort of wanted the Ackerman family to, loosen their hold on the company?
Yes, well, let's compare the situation 24 hours ago to now. Or call it 26 hours ago, because the sale was announced 24 hours ago. So 24 hours ago, there were a lot of people who wanted to buy shares, and they needed to buy shares in the market. Now, 1.6 billion rand of those shares have found those buyers. So there are less buyers than there were 24 hours ago. So that in itself puts pressure on the share price, because there are just as many sellers as 24 hours ago, but 1.6 billion rand of buyers have now gotten their shares that they applied for with the broker that placed those Ackerman shares. So it's always natural that when there's a big placement, it means some buyers are taken out of the market and the share price falls a bit, as we saw today. It obviously was a red day as well.
Yeah.
But longer term, yes, it is positive, although it's not as if the Ackermans crossed a level of control. They went from a voting perspective from just under 50% to just over 35%, and they sold a third of their economic interest. But that's not that material. So it has a small impact on governance, I would say, but it had a short-term impact on the number of buyers, and longer-term Pick n Pay's fortunes are not so much what is going to happen between buyers and sellers of the shares. It's more what the management team are going to do in terms of execution. So that is the focus for Sean Summers to really execute well on the turnaround.
All right, and focusing on that turnaround plan, Grant, we did see on the last set of numbers, Pick n Pay still under pressure, but the clothing business doing well, and some of the other businesses also doing well. So we are seeing some short-term pressure when it comes to the share price. But what's your sentiment around Pick n Pay over the long term?
Yeah, it's a tricky one. Like you said, they've got some good businesses. Clothing is a great business. Boxes are a great business. The core Pick n Pay business, though, is still closing down stores. They're still shrinking their space. They're still trying to stabilize and grow volumes like for like. And I think we've started to see that. But it's still loss-making. For me, I'd like to see a bit more before I have confidence in the turnaround strategy. It's fiercely competitive out there. The competitors are investing heavily in price. And you know, inflation's a bit lower at the moment, so I'd like to see more. I would wait on the sidelines, and I like Boxer. I would rather own Boxer. It's unfortunately we can't buy the clothing business, so for me, I would sit out at these levels. Yeah,
A Boxer or Pick n Pay, what would you get into at the moment, JP?
I'm also in the Boxer box. I like having direct access to a great business, and turnarounds are tricky, especially in the retail sector. So I prefer to hold my Boxer directly.
All right, let's get into some questions on Telco's players. Telkom out with numbers today, earnings coming in higher, still posting solid growth when it comes to the prepaid market, but of course warning of margin pressure moving forward. Your thoughts on that print, Grant?
I thought it was a solid print, and it looks like they're taking market share, growing at a much better rate than MTN and Vodacom in South Africa. The thing with Telkom is they're really a South African play, and this whole industry is also it's mostly an ex-growth industry, and so if you're not taking market share, you're not growing, as you saw with MTN and Vodacom. The competition from these MVNOs is fierce as well. And that's pressuring fees and revenue, the ability to pass on price increases and margins. So I like, if I had to look at the sector, I like those that have some proper growth optionality in Africa, because I don't think you're going to get enough of it in SA. And at some point, Telkom's going to run out of market share steals. So yeah, it's a good result. It's a solid number. It doesn't excite me personally.
Do you share the same sentiments as JP, as Grant there, JP? I mean, you know, especially considering what the SA growth picture looks like, we've been hit by a wave of optimism since last week on the back of the mini budget, the S&P credit rating upgrade as well.
Exactly. So yes, in the telco space, growth is going from Africa, not South Africa. Of the four telco players, mobile operators, the fourth one is going to list soon. Telkom is winning market share. In this result, they also stemmed the issues at BCX. So they are doing a good turnaround there. And then they've got a strong balance sheet after they sold the towers, the property division, Gyro. So all in all, it's a solid business. And if they can get a little bit of revenue growth that can filter through the income statement to double-digit profit per share growth, but only for a while. So I'm on the same page as Grant when it comes to Telkom, yes.
So some nervousness, some caution when it comes to the longer-term picture. Just sticking with you, JP, the prepaid market, of course, also reliant on consumer spending power. And just last week, we also heard from Vodacom warning of online gambling and how that is eating into consumers' spend on airtime in particular. Many businesses have warned against this, the likes of a TFG, Pick n Pay, as well as famous brands. Let's get your views around this. We spoke about this, I think, with Grant sometime last week as well.
Yes, all the retailers are moaning about gambling, online gambling, and how much of people's spend is going towards that activity. But the retail shares have been under pressure in South Africa because of the macro environment and because of some spending pressures as people divert money away from clothing towards gambling. We'll probably need to wait and see if we can clamp down on the illegal gambling, while perhaps bring in some more taxes or certain safeguards for the legal gambling, whether it is to avoid minors playing these games, because sometimes because you can play using vouchers, it's difficult to always check whether the person who's gambling is necessarily above the age of 18, because they might pay with a voucher rather than a credit card, which you would expect only adults would have. So it's a tricky situation. In the interim, there are some opportunities if you're missing the shares of companies that operate in this sector. There's a New York-based business, Super Group, not the South African Super Group, the one listed in New York. They are an interesting opportunity to invest in. And then if you think about the lotto, we've got Gold Rush listed on the JSE, a relatively small and illiquid company, but they could benefit from winning the tender for the next few years for operating the lotto. So there's always two sides of the coin, some negativity for people who want to invest in retail shares, but some positivity if you want to invest directly into some of the gambling operators.
So if you are asking where should I invest for best share price growth over 5 years in Capitec, Standard Bank, Absa, FirstRand or Nedbank, Grant, surely you'll get gains from all of them, but I guess where will you get the most gains?
Yeah, I mean, it's actually a good question. We're taking a 5-year view. So in fact, one of my stock picks tonight is a bank.
Okay.
But it's not based on a 5-year view. It's probably a 1 year to 2 year view, to be honest. But look, Absa is probably the cheapest, Absa and Nedbank. So if they execute well, you're going to probably get the bigger upside there. Capitec, the fastest growing, but you're paying up for it. Standard Bank, I think, walks the middle line pretty well in terms of the growth and, already doing a lot of things right, but not quite at Capitec's level. So, yeah, that's actually a very tricky question. I tend to invest, if I'm thinking 5 years out, I tend to think more along the lines of where the growth is coming from. So, because the valuation matters a bit less and the actual fundamental drivers of the earnings matter more. So I would go with Capitec. If I had to put my hat in the sand on a 5-year view, on a 12 to 18 month view, I would go with an Absa. That's my double.
All right. And what about you there, JP? Capitec for what? Close to 4,000 Rand at the moment? Or an Absa that's on the lower side of the scale?
Yeah, I'm toweling. That's a difficult question, as Grant has also explained it. You have the value opportunity or the growth opportunity. And the more you extend your investment horizon, typically the growth opportunity becomes the better opportunity. So I would agree with Grant on Capitec for the long-term growth opportunity. But you did say share price growth. So I would just add to the conversation by saying, don't underestimate the power of dividends. The likes of Absa and Nedbank are, I think it's above 8% dividend yields. That's a very powerful part of your return that some people don't really give a lot of attention to. But over a long period of time, your dividends, especially if you reinvest the dividends, just buy more of the shares from your dividends that you get. That can be very powerful. So don't underestimate the power of dividends as well.
Something here on MultiChoice. Is there any residual payment to follow after delisting and suspension? I don't think that's the case, right, JP? Shareholders that didn't accept that Canal Plus offer will be automatically bought out of the offer price, right?
That's how I understand it as well, that there's no achterskot, as sometimes is the case, no contingent payment. What would have been nice if Canal Plus had listed on the JSE before this is all wrapped up, so that MultiChoice shareholders maybe had the choice to swap into Canal Plus, but that's not going to happen. So all you can do is you'll get your cash from MultiChoice, and then if you want to reinvest in the same asset, you need to wait for Canal Plus to list on the JSE, and then you can get indirect exposure by buying Canal Plus. Although, if I think about the valuation at which MultiChoice was bought out, I think take your money and run and rather invest in other parts, because there's a lot of pressure on the pay TV market.
Yeah, there is. Let's move over to Reinet. Would the panel recommend holding Reinet in my portfolio, Grant? They read the financials released today. Softer NAV on the back of, some struggles or some limited struggles in some of their holdings. But the group, of course, still cash positive on the back of the sale of their stake in BAT and the pension incorporation, the pension insurance corporation business as well.
Yes, I think this is a nice, portfolio cornerstone, if you like, because you've got all pounds, so it's a good rand hedge. They've got over £2 billion in cash now. They've been selling down some of their private equity, monetizing some of that. It's trading around 22% discount to NAV, which is also reasonably attractive. It's been wider at times, but that's still a decent discount. They've got some interesting private equity exposure, some of it to China, some of it to Cotu, the global tech investor. So I think you should definitely hold on to it. I think it has a place in a diversified portfolio, and it brings something completely unrelated to the South African economy and what's going on here. So that's a nice diversifier.
And JP, there's been questions around what Reinet will do next with, the cash on hand. And just going through the numbers, it does seem like they're being a bit more cautious considering what we are seeing in markets.
They are being more cautious. What they are going to do with the group after they get the cash from Pension Corp is the $1 million question. And I mean, more than 100% of the share price or market cap at that point in time, probably near the end of the first quarter of next year, when they get the cash for Pension Corp, will be cash. So they made a little bit of additional commitments in this past quarter for some of their smaller funds that they've invested in with these third-party managers. But it doesn't make sense that they continue as they are. They either need to pay out a huge special dividend, or they need to buy out minorities closer to the NAV. But they need to do something, because just having a listed cash shell, which is quite large, so therefore you can't just buy anything. You need to have you basically have an elephant gun. You need to wait for some elephants to come around before you can add something to your portfolio that can move the needle. It's not a comfortable situation to be in. Now, Mr. Rupert doesn't need to feel comfortable. He controls the business. He won't succumb to pressure from external shareholders, but at the same time, he generally does things that are good for shareholders. And I would say what is good for shareholders is if there's a value unlock sometime late in the first quarter of next year. So let's wait and see. I'm hoping there is. I hold Reinet shares in the funds under our management, so we are hopeful that something could happen.
And are you seeing value over on the international side when it comes to these athleisure-like brands, the likes of a Nike, Lululemon, and On Holdings, JP?
Well, Nike and Lululemon has been under enormous pressure. They got their distribution wrong, or in the case of Nike, they got their distribution wrong a few years ago. They want to go direct to their customers and bypass retailers. That backfired, and Lululemon has always been at a very high premium. They've now lost that premium for their products. So both those share prices have been under enormous pressure. When it comes to exposure to the athleisure market, a company that's also been under pressure, but it's my preference, is Deckers Outdoor. They own the Hoka brand of shoes, the thick soles, as well as UGG boots. So even though it has also suffered as a share price together with Nike and Lululemon, it is my preference in the athleisure sector.
And what's your preference in that sector? We can even bring in the likes of an Adidas, Grant.
Yeah, that's a great question. I mean, I think Lululemon has lost their way a little bit in terms of what, their innovation, and there's a lot of competition. There's a lot of new brands that are up and coming and taking share from them. And of course, denim is now all the rage, and that Lulu doesn't really make denim. So I think they're going to struggle there as much as they've got a great history. Nike is struggling to turn the business around. I think they'll get it right eventually. It's too good a brand not to, but that's a longer term turnaround. On Holdings is doing an incredible job. I mean, if you've been a shareholder for the last couple of years, you would have done really well taking share from everyone. But I think they really are pricey, and I think it's too expensive to be buying it now. These brands come and go out of fashion, and it's going to come a time when it's less fashionable, and you're going to get burnt on that. So I would think so. I would be a little cautious on that. I like, actually, for value, I like the Chinese equivalents, the Anta and the Li Ning, are really offer a lot of value. They've got a very good brand presence in China. A lot of the foreign brands have lost their attraction there, and it's like a very nationalist thing to buy the Chinese brands. So I think that's probably where I see more value in the athleisure space.
And where else are you seeing value, Grant? Let's get into your stock pick.
So on the theme of earlier, my stock pick is ABSA.
No
and
surprise.
I think there's a number of reasons. So I think, starting off, I like Kenny Fiedler's move to ABSA. He's been playing, let's call it second fiddle at Standard Bank for many years, and he's not getting any younger. I think he's come to prove a point. I think he's going to be very proactive, and he's going to be, I dare say, aggressive, but he's going to make moves. He knows Africa well. He knows investment banking. That's where the growth opportunity lies. So I think you're going to see some proper energy coming out through that business in terms of appointments and strategy. And then, of course, you have a favorable macro environment, the ratings upgrade, cost of funding coming down. This is all good for the banking environment. It should improve the macro in SA next year as well, over the next year or two. So there's a lot of macro tailwinds plus fundamentals in the business that I like. 7 times earnings. I think it's less than 7 times next year's earnings. Dividend yield of 7.5%, 8% forward. So the fundamentals are there. If he can just get some delivery, some margin improvement, some growth, some ROE uplift, I think you're gonna do very nicely out of that one. So that is my pick. It's ABSA.
All right, and where are you seeing opportunity, JP? What you're hanging your hat on?
Darling, so we started the show talking about how global equity markets have been under pressure the last few days. So quite a few shares have fallen a lot. Now I'm staying away from AI, but I'm going still with the technology related stock. It is Rightmove. Now Rightmove operates the dominant online platform for buying and selling houses in the UK.
Okay.
So if you think about the South African equivalent, it might be Private Property or Property 24, the websites. So Rightmove is where people go when they want to buy or sell a house to see what's on offer. And the share price has fallen a lot in the last few weeks, mostly because there was some statistical data that came out and said that UK house prices have now fallen slightly in the last quarter, which frightened a few people because obviously prices going up, it's much better for a platform that takes a commission on rising prices. Falling prices not so good for a platform. And the other thing is that Rightmove had a investor day, and at that investor day, they decreased their targets for how much they could grow in the next few years. But the decrease was relatively small, and the share price reaction, I would say, was an overreaction. So because of that, I think the sharp share price on slightly lower forecasts for Rightmove creates an opportunity in a generally expensive global equity market to buy a dominant online platform that could do well then over the long term as the economics in the UK normalizes.
All right, so Rightmove for JP and ABSA for Grant. Gents, let's leave it there. Thanks so much for your time this evening. Now, that was Grant Nader from Benguela Global Fund Managers and JP Verster from Protea Capital Management. Up next, The Close. Stay watching.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.